Hello, my name is Todd Ganos, and thank you for joining me on this on-demand webinar regarding the elimination of state-level income tax on the sale of a business. Before we get into any of the strategies, I'd like to address a question that often comes up. Why doesn't my accountant or attorney know about these strategies? And the short answer is, it's not their job. They advise you on a broad array of subjects, and they don't have the time or the resources to do deep dives on every single discipline. So you need to bring in a technical expert for a particular subject, such as merger and acquisition taxation. So don't be too hard on your accountant or attorney if they seem unfamiliar with this. It really is not their job to be able to do deep dives in all of these different disciplines. So we're going to start out with a particular strategy called the Nevada Incomplete Gift Non-Grantor Trust, or NING Trust. Now that's a mouthful, but to tax practitioners, it's descriptive of its attributes. So the first tax attribute is that transfers to the trust are not taxable. So this means that if you were to transfer your ownership interest to one of these trusts, that in itself is not a taxable event. The second key tax attribute is that the trust pays its own income tax. So if the trust were to sell your business interest, it is the one that pays the income tax on the realized gain, not you. And because the trust is domiciled in the state of Nevada, and Nevada has no state level income tax, this is how we sidestep your state level income tax. So how does this look visually? Well, here we go. It's actually pretty simple. Here you are, you make a contribution to the NING Trust, and then the NING Trust itself then sells the ownership interest to the buyer. Now, there's a very important point, though. You need to have this structure in place before you identify the buyer. Now, this goes back to a U.S. Supreme Court ruling that occurred over 100 years ago, and something involving what's called the assignment of income doctrine. Pretty nuts and bolts stuff. But in either case, the point is you have to have the structure in place before you identify that buyer. And that's basically what is needed for this structure to work. Okay, so let's look at some numbers here. Let's say you have a middle market company. So here we, say a lower middle market company with an enterprise value of $25 million. You have a $5 million basis in the company. And so you have a $20 million gain you're looking at. Well, in this example, we're going to take a California resident seller doing nothing but just, here's my company for sale. Well, that seller is going to have a combined federal and state income tax rate of 34%. That's going to translate to a tax liability of just under $7 million, and then after-tax proceeds of just about $18 million. Well, if we employ the NING Trust strategy, our tax rate drops down to 24%. Well, why 24%? Well, when we're talking about higher dollar numbers, we're talking about a 20% capital gain rate and a 3.8% net investment income tax rate from the Affordable Care Act. And so call it 24%. So here, the tax liability is going to drop down to just under $5 million, and your net after-tax proceeds increases by $2 million up to $20 million. So that tax reduction equates to about a 30% reduction in the total tax dollars that are being paid. So the natural question is, well, is this stuff legitimate? Well, there's a process where we can go to the IRS and we can ask them, when our owner is transferring their interest to the trust, is that a taxable event or not? If the trust then itself sells the interest, is it the trust that's taxable? So there's this advanced ruling called the private letter ruling. And over the past 20 years, there have been 80 favorable rulings from the IRS on these types of structures. So we know this stuff is real, it's legitimate, and no one's hiding the ball. We show Forbes and Bloomberg and Wall Street Journal that these structures have been widely reported in very popular news outlets. And so no one's hiding the ball. If you were to Google NING Trust, do a Google search on NING Trust, you're going to get 5 pages of results. So believe us, this stuff is real. And here is one particular private letter ruling that our firm received for a structure that we put together for some folks. And we've received multiple private letter rulings on the structure. So we have a pretty good sense that this works, okay? So, but wait a second. What if the Ning Trust is not right for you? Well, so it works that based on your specific state of residency, maybe a Ning Trust works, but maybe there's a different trust that's going to work. And so if you live in California or you live in Massachusetts or you live in North Carolina, yeah, the Ning Trust is going to work. But if you live in a state, let's just say Minnesota or Georgia or Kansas, we're not going to be using the Ning Trust for you. They're going to be a different trust structure. The takeaway is, though, that something can be done for you, okay, whether it's a Ning or some other kind of trust. But the bottom line is it's going to be tailored to you, and it's going to be tailored to your specific state of residence. And so it's fine print here, but here we have two rulings out of California. And the idea is we're going to go down to your state statutes and their regulations to determine what is going to be the best structure for your state of residency and the sale of your company. So beyond the income tax, though, we would want to try and embed asset protection and estate tax planning as well. So if we can kill three birds with one stone, not just two and certainly not just one, we're going to want to try and do that. And then beyond taxes, is your company ready for sale? You need to be thinking about more than just taxes. And so on our website, we have a survey that you can take that gets you thinking about the questions your buyers are going to ask you during due diligence. So you can assess how your company is prepared for sale. This survey is actually being done in collaboration with a nonprofit organization and a West Coast university, and it's the subject of a doctoral dissertation for a student. So if you can participate in this, get a sense of your own company's readiness, and you'll also be helping this research out. So what is the right structure for you? Well, why don't you drop me an email at todd@integratedwealth.com, and we can start a conversation about this. You can also visit my column on Forbes. The address is there below, and I talk about typically business sales and the taxation of business sales. So I wish you the best of luck in your preparation for the sale of your business and also the reduction of your tax liability. Drop me a line. Let's get the conversation started.